This is Mercer Buller, Director of the Business Law Institute at the University of Mississippi School of Law. This video is part of our series on the basics of accounting. It covers the statement of cash flows. It assumes you understand the fundamental concepts of accounting, the equation assets equal liabilities plus shareholders' equity, and double-entry bookkeeping. It also assumes that you understand the elements of the statement of income. The purpose of the statement of cash flows is to show the change in the business's cash position during the time period measured. That change will equal the netting of all the cash that comes into the business and flows out of the business. Consider a business that starts the year with $1,000 in cash. The business writes a check for $100 to pay its employees, and it receives $100 payment for 10 widgets. The business's ending cash position will be $1,050. It will have a positive cash flow for the year of $50. Unfortunately, the statement of cash flows is not created this way. The statement of cash flows is created by converting the income statement to cash. This is a problem because the income statement is not based on cash flowing into or out of the business. It is based on accrued expenses and accrued revenues. To convert the income statement to cash, we need to make a number of adjustments. Let's see how this looks. This is General Electric's income statement for 2013 and 14. This is the bottom line, the literal bottom line, of the income statement. Net earnings of $15.2 billion. This is the starting point for the statement of cash flows. Here's the statement of cash flows for General Electric for 2013 and 14, with the income statement in the bottom right corner, where GE's net earnings is circled. This amount will go to the top of the statement of cash flows, and we will then make adjustments to it in order to determine how much cash flowed into and out of the company. What appears below net earnings is a list of adjustments to net earnings that remove accrued revenue and expenses and add cash payments and receipts. Let's look at one of those adjustments. This one shows about $19 billion is subtracted from net earnings for current receivables. These are operating receivables. In other words, they are receivables from operating revenue. Although receivables increase during the year, it is shown as a negative number. In other words, we are subtracting this amount from net earnings. We want to understand why this happens. We recall that receivables are created when widgets are ordered but not paid for, as required by the matching principle. Here, a $100 order for widgets was received in year 2 and paid for in year 3. And this means that $100 will be added to receivables in year 2 because none of this order was paid for in year 2. Net earnings will be increased by $100. But no cash was received in year 2. So if we want to translate the net earnings into cash, we need to take that $100 out of net earnings. On the statement of cash flows, you would subtract $100 from net earnings. But that's not the whole story. The business also sold $50 of widgets in year 1, and they were paid for them in year 2. This cash payment increased the company's cash, but it was not included in net earnings. It was included in net earnings for year 1. So this cash payment received in year 2 needs to be added to net earnings. Netting the two adjustments gives us a net of $50 that needs to be subtracted from net earnings. Another way to approach this is simply to take the change in receivables for the year. Let's see how that would work. At the beginning of year 2, let's assume there were $50 in receivables from the year 1 sale, and we increase them by $100 to reflect the year 2 sale. And we reduce them in year 2 by the $50 payment on year 1 sale. At the end of the year, receivables equal $100, an increase of $50. The adjustment to net earnings on the statement of cash flows is the same, except the positive flips to negative. Let's assume earnings were $50 in year 2. The $100 increase in receivables needs to be subtracted from net earnings because it does not reflect a cash transaction. But the $50 cash payment needs to be added to net earnings because net earnings did not include this payment. The net effect is a $50 deduction from net earnings. Receivables have increased, which means that net earnings must be reduced. The effect on receivables and net earnings in the cash flow statement are inverted. When one is positive, the other is negative, and vice versa. We now have a rule for adjusting net earnings in the statement of cash flows to reflect operating receivables. The adjustments will equal the inverse of the change in receivables during the year. If receivables increase during the year, net earnings are reduced by that amount. If receivables decline during the year, net earnings are increased by that amount. Let's test this rule in practice. Here's the GE statement of cash flows again. You can see that the adjustment for operating receivables is negative. Now, if our rule works, this means that GE must have had an increase in its operating receivables during the year of about $1.9 billion. We can get that number from GE's balance sheet. This is the line for current operating receivables. And when we blow that up, we see that receivables rose from about $21.4 billion to about $23.2 billion, an increase of about $1.8 billion. And this is approximately equal to the $1.9 billion on the statement of cash flows. Except on the statement of cash flows, it is negative. The adjustment to net earnings is the change in receivables. We now should have a good grasp of how the statement of cash flows works. We start with net earnings. We make adjustment to net earnings to reflect accruals, such as the change in receivables, and to reflect cash transactions, such as payments on receivables. And after making those adjustments, we have the change in cash for the time period measured. Now we can provide a picture of the change in the business's cash position. We take the cash at the beginning of the period and add or subtract the change in cash, which gives us the business's cash position at the end of the period. Returning one last time to GE's statement of cash flows, here is its change in cash, which is the difference between its beginning and ending cash positions. This concludes our introduction to the statement of cash flows. The statement of cash flows is intended to show us the change in the business's cash position during the time period measured. We also have addressed the most difficult aspect of the statement of cash flows, and that is that it reflects the translation of an accrual-based income statement into cash. We used receivables and payments on receivables to illustrate how the income statement must be adjusted to remove accruals and to add cash. A good understanding of this approach will give you a solid foundation for the discussion of the elements of the statement of cash flows in our next video.